Do you want to start investing in the stock market but feel overwhelmed? You're not alone. The good news is, investing doesn't have to be complicated. In fact, anyone can get started, even with just a small amount of money. In this video, we're breaking down simple, practical steps to help beginners start investing with confidence. Make sure to stick around until the end, because the last tip could help you maximize your returns. Let's get started. Number 1. Understand the basics. Before you invest, it's important to know what the stock market is and how it works. The stock market is a place where investors buy and sell shares of publicly traded companies. Stocks represent ownership in a company. When the company grows, your investment can grow too. Prices go up and down based on supply, demand, and company performance. The key to successful investing is buying quality stocks and holding them long-term. Number 2. Set your investment goals. Before you start, ask yourself, are you investing for retirement, wealth building, or short-term gains? What's your risk tolerance? Higher risk equals higher potential returns, but also more volatility. How much can you afford to invest? Start small and grow over time. Having a clear goal helps you choose the right strategy and stay focused. Number 3. Choose the right investment account. To start investing, you'll need a brokerage account. Here are some great options. Traditional brokerage, platforms like Fidelity, Charles Schwab, robo-advisors, automated investing platforms like Betterment or Wealthfront. Apps for beginners, easy-to-use apps like Robinhood, Webull, or M1 Finance. Most of these platforms offer commission-free trades and user-friendly tools for beginners. Number 4. Start with index funds and ETFs. If you're new to investing, index funds and exchange-traded funds, ETFs, are great choices. Index funds. These track the performance of a specific market index like the S&P 500. ETFs, similar to index funds but trade like stocks, offering flexibility. Why choose these? They offer diversification, low risk, and steady long-term growth. Some top ETFs to consider: SPY, VOO, or QQQ. Number 5. Invest in individual stocks, if ready. Once you're comfortable, you can start picking individual stocks. Do your research. Look at company earnings, leadership, and industry trends. Choose strong companies. Brands like Apple, Microsoft, or Amazon have long-term growth potential. Think long-term. Avoid panic selling during market dips. Remember, investing in individual stocks carries more risk than index funds. Number 6. Use dollar cost averaging. Instead of trying to time the market, use dollar cost averaging, DCA. Invest a fixed amount, e.g., $50, at regular intervals, weekly or monthly. This reduces the impact of short-term market fluctuations. Over time, you buy stocks at an average price rather than worrying about market timing. This strategy is perfect for beginners and long-term investors. Number 7. Reinvest your dividends. Many stocks and ETFs pay dividends, profits shared with investors. Instead of spending your dividends, reinvest them to buy more shares. This leads to compound growth, helping your investment grow faster over time. Set up automatic dividend reinvestment, DRIP, with your brokerage account. Even small dividends can add up big time over the years. Number 8. Avoid common beginner mistakes. Many new investors make costly mistakes. Here's what to watch out for. Investing without research. Don't buy stocks just because they're popular. Chasing quick profits, day trading is risky. Focus on long-term growth. Ignoring fees. Watch out for hidden fees that eat into your returns. Emotional investing. The market will go up and down. Stay patient. Avoid these mistakes, and you'll set yourself up for success. Number 9. Keep learning and stay consistent. The best investors never stop learning. Read investing books like The Intelligent Investor by Benjamin Graham. Listen to finance podcasts or watch educational videos. Track your investments and adjust your strategy when needed. The more you learn, the better your investment decisions will be. Number 10. Think long-term and stay patient. Investing is a marathon, not a sprint. Wealth building takes time, but staying consistent will pay off. Start now. The earlier you invest, the more time your money has to grow. Stay the course. Don't panic sell during market drops. Trust the process. Compounding works best when you let your investments grow. Even small, regular investments can turn into huge gains over the years.